Now we'll talk about how we can minimize loss and maximize the profit. So as we discuss the general rule of 10%, let us try to understand this in detail. So when your stock reaches, let's say in worst cases, let's say in a same day, in this rule, what you should do is exit first, and find the reason later, because we don't know after the fall of 10%, the consecutive days there would be more fall of, let's say, 15% or 20%, and that those should be the early signs that we should be always exiting the trade. So our goal here is not consume the loss of 10%. Our goal here is to conserve the remaining 90%, and those 90% can relatively give us profit in another stock. Okay, so we should be quick in exiting a loss. We should be quick in taking the loss or exiting a position. The reason is the damage of capital may become irreversible. I think most of us have one or two stocks in their portfolio which have corrected by 90%, or maybe 100% probably, if the company has got delisted. So if you just take this particular example here, let's say on first trading day, you incur a loss of 10%. Okay, you enter a stock, there is some really bad news, or the bad market has caused the stock to correct by 10%. Now, stock of 1000 rupees has corrected to 900 rupees. Okay, your loss in percentage is 10%. Okay, now from this 900, if stock has to reach to 1000 levels again, it has to go up by 11.1%. Okay, so your loss is 10%, but stock has to take effort of 11.1%. Now again, here we are not considering brokerage fees, etc. Those would be around 0.5 to 1%. Okay, if the stock on the next day corrects by 10% more, your stock price would be 810 now. Your total loss would be 19%. Okay, and stock has to take effort of 23.5%. Okay, it's a significant difference now. Okay, so correction is of 19%, the stock has to take effort of 23.5%. Okay, now let us jump directly to 50%. Okay, so let's say by 10% the stock is coming down. By the way, in some stocks, if you remember, this happens in a day also. Okay, in a day also this damage can be done. But let us say we don't exit and we continue to take the losses. So what happens is, let's say your stock is down by 52% almost. Okay, now from this level, if the price has to correct to reach back to original level of 1000 rupees, the stock has to correct by 109% point one. Okay, so it's 109.1%. Okay, so almost the stock has to double. Okay, so we always dream about sitting on a stock which will give me returns, it will double in a month or two, and we always find hard to find such kind of stocks. So how can we expect from a certain stock which has so rapidly or so fast corrected, and we are expecting multi-bagger effect from that stock? So that is almost impossible to achieve. Okay, so what we need to understand is, the moment losses starts to widening, there are very less and less chance of you to come out of that particular loss. Okay, and in most of the cases, this would almost be impossible to achieve. Okay, unless there is some rumor, or the bear cartel has pulled down the value significantly. Okay, so if you just check that, in case you exit at this level, okay, and probably once the damage is done, we know that market discounts everything, the prices will be corrected in advance, news will come later. So that is the reason, when the if your security is making loss of 10% since the time you entered, I think 10% is a good level to exit. Okay, most of the times we try to rationalize our decisions, we try to give some kind of logic to your trading decisions, but that is how we pay a very hefty, that is how we incur very hefty losses, and that hits really badly to our trading portfolio. So this is the graphical representation of the same chart. You can see that The amount of losses are just by 10%. Those are almost linear, but you can see the amount of damage that it is going to create to your portfolio, the amount of effort that the stock will require on each down cycle. Okay, so if we just check this previous document one more time. So by this time, let's say when your stock price corrects by 89%, okay, and which is quite possible, your stock price has come down to 109.42 rupees, and the stock has to take effort of 813, that is, has to multiply itself by 8 times. Okay, that is when your original price will be reached. Okay, so I don't know how many of us have really invested in multi-bagger stocks, which gives 8 times returns. Okay, to get 8 times of returns, the stock has to be really doing well. Okay, and which is unfortunately not going to happen with this company. Okay, so the bottom line is, don't expect multi-bagger effects from a fallen stock. Okay, this is never going to happen. Okay, so fall of 10% in will give you a stock price of 900 rupees. Of, let's say, your buy price was 1000 rupees. The loss is 10%, but the effort would be 11.1%. With even with 25%, which looks digestible loss for most of us, stock price would be 750, and we'll have to make the effort of 33.3%. Okay, most of the companies, they give a profit margin of 10% on quarter basis. So let's say we are talking about 10% of profit each. We're talking about 33% over here. So obviously you'll have to sit on that particular script in order to get 33% reason 33% result for 3 quarters at least. That is the time of 9 months. Okay, so I think it will be very difficult for the stock which is corrected by 25% will have a smooth rally to increase your stock value by 33%, in another 3 quarters. However, there are more chances of correcting, as in it will go down more. The reason is, in the first quarter, even the 10% will not make people to jump onto the script to buy heavily. Okay, similarly with 50%, we know that it has to double. Okay, so the effort is double. With 75-90%, the chances are almost impossible that it is going to recover. With 90%, we know that it has to take effort of 900%. That is 9 times it has to multiply itself to reach to your original price of 1000 rupees. So what are the common mistakes that we do, and we should not be doing? So we always tend to keep working on information, text messages that we receive. We constantly follow news channels, and we do not rely on numbers and data, so which are depicted by the charts. Okay, so we are heavily relying on these kind of information, which is basically planted, so which are the part of campaigns run by the news channels or operators. Another most common mistake that we do is we don't book our losses quickly. We have very strong cognitive biases about our trading decisions, that how I can be wrong with a particular trade. So cognitive bias is a very interesting subject to learn. Obviously, we cannot cover this into today's session, but I will try to provide a few links in case you guys are interested. Read about cognitive biases, and this cognitive biases will also help you understand what wrong decision, how exactly incorrect decisions we make, and we tend to rationalize those incorrect decisions. And unfortunately, our cognitive biases or incorrect decision making is something that disturbs our trading portfolio. And those are basically based on emotions, and we know that which are the strongest emotions which would be working against us. One is the fear, and other one is the greed. We also don't maintain profit and loss statement. Most of us usually have 2 or more trading accounts, or in case we are managing accounts of our parents or siblings or spouse, then those could be also cases we don't maintain a single balance sheet, and or we don't maintain a profit and loss, and don't see where exactly your trading is going to end. Also, not having a goal is also something that stops us for becoming a profitable trader. So simple goals like, let's say, 10% CAGR, 20% CAGR, 30% CAGR. You can of course increase this over years, but I think there has to be some goal. Otherwise, either we will overtrade or we will undertrade. Okay, overtrading is a phenomenon wherein we are constantly getting certain profits, and then we start to trade more and more, and the losses are more and more, in fact, in those cases. So the profit vanishes, whether we should be ideally we should be take break from the trading. So we should always know when to start. It is not that we should be trading all the time in the market. There would be a couple of months where you could not be in a position to or ideally you should not be creating any fresh trade. So especially in the sideways market, where it would be difficult to make money, we can just sit outside the market, we can sit on the cash, we can have that cash invested somewhere else, and take a trade only when there is a strong up move, or a trend confirmation on either side, up move or down move. Also, one small point, that we consume a lot of information without any analysis or thinking. So we know that over WhatsApp and or even on your cell phone, we constantly keep getting news articles about a certain script, that it is going to go at this particular level, or it is going to go it is going to fall. These kind of news would always be there. Unfortunately, in India, you'll always find bullish news, rarely find a very strong negatively opinionated kind of a news. People don't want to go against a certain company or a certain group of people, so you'll hardly find any news that will indicate that you should be exiting from this particular stock. So in India, it's always about targets, it's never about stop loss levels. So now we know that what mistakes we usually do. Now let us understand what can we control. So let's say you buy stock at 100 rupees, it corrects by -5, and that was your stop loss level, let's say at exit 95. So at 95, if you exit, your loss is -5%. Okay. But let's say your original target was 105 rupees. Okay. So technically, if this is your buying price, if the trade had went in your direction, you would have made 5% as profit. Okay. But from this level, the stock has to go by 10 rupees, or in, let's say, XYZ%. And that is only when the original 105, as a return you'll get. Okay. So your returns are still same. But why we want to not exit here and continue based on some study that it will eventually go up. Okay. So only 30 or 35% of the time this might be true, that you held on to your position and the stock went up, and you exited at 105. Okay, that give you a profit of 5% or 5 rupees. In most of the cases, what is going to happen, your buying price was 100, -5, your SL level is reached and you did not exit. So what will happen, it will fall further, and it will reach to 90 rupees. Okay. Unless you're working on unless, and these kind of scenarios are only possible when overall market sentiments is very positive, markets are going in, there's a bull run and market are performing really well. Only in those cases this would be possible. Otherwise, in weak markets, chances of this happening are more likely. Okay. So what we can control, we can control only buy price and exit price. Okay. These are only two things that we can control. Everything else that happens in market cannot be controlled. Okay. So as a trader, we should be able to buy at correct levels. Okay. And we should be ready to exit at weak levels, or at your target levels. So one common mistake that we all do is we usually try to extend our losses. Okay. And if there are profits, we try to usually exit out of those positions immediately. Okay. So we end our profitable trades very quickly, and we exit our stocks or exit our weak stocks very late. Okay. So this keeps damaging. So what we are doing is basically We are not allowing our strong horses to run, okay, and we are feeding our donkeys, okay, and expecting them to run, okay. So that is not going to happen. So only thing that we can control is correct buy and exit point, and this has to be maintained emotionless. There could be some scenarios wherein you might want to extend your losses, and this usually the case when you're working on a very large position size. Let's say you have a holding of 1 cr or 2 cr in a single script, and booking a loss of 4 or 5% talks about 4 or 5 lakhs rupees, okay. And if assuming that is having that is happening in the same day, so what you can do in these kind of scenarios, or even in small portfolios, what you can do is you can keep staggered stop losses, okay. If you know that there are less chances of this stock going up, what you can do is you can sell one third at certain level. Let's say I'm selling one third at -4%. Then I'm selling, the stock corrects again, it goes to 6%. I sell one third position, that is -6%. Okay. So let's say I have 300 shares. My buying was 100 rupees. So my total trade size is this. Okay. 30,000. So what I'll do, I'll sell 10,000 worth of shares here. Okay. Or I'll talk in terms of quantities because I have 300 shares. I'll say I will sell 100 shares here, 100 shares here, and 100 shares here. Okay. So I have booked loss of 4 rupees here. Okay. I have booked loss of 6 rupees here. I have booked loss of 8 rupees here. So these losses are per share. Okay. So this is loss of what, 400 rupees here, 600 here, and 800 here. But if we take average loss, it would be 6%. So your average loss would be 600. Now, what is benefit of this particular strategy? There could be chances that the stock will bounce back from this level, okay, or it will bounce back from this level. So you'll anyways have some position which will help reducing this particular loss, or in case it bounced back from this level, so it will help reducing this and this loss altogether. So what is going to happen is when the stock moves up, okay, it has to take lesser amount of effort, okay. So staggered stop loss, very important strategy that can be done, so that will ensure that you minimize losses in some percentage. While creating your trade or while entering into a trade, we should be always sure about what is the risk and reward ratio. So what is the risk on capital I'm taking to achieve what level of reward, okay. So if I can take, let's say, 1% of risk on capital of 1 lakh, that is 1,000 rupees, and if I'm going to get, let's say, 5%, okay, so on 1 lakh I'm going to earn 5,000 rupees, and if I lose on the trade, my loss would be 1%. So my risk to reward ratio in this case is 5:1. Okay. So my risk is 1 time and my profit will be 5 times of the risk. Okay. So the reason behind using this is we should never lose more than what we can gain. Okay. So it shouldn't be like that chances of winning and losing are equal in stock market. The reason is we know that stock markets are zero sum game. So one is to one is not going to work in our favor. Okay. So we should be at least maintaining risk and reward ratio of 2:1. So let's say if you're going to lose 100 rupees on a trade, with if your stop loss is hit, you should be able to make 200 if the trade is successful. Okay. And the more and more trades are getting successful, you can see that there is more and more increase in the profit ratios. So again, how to calculate this? Let's say your buy price is 100 rupees, your risk would be -5%, so 95 would be your exit level, and your reward is 10%. Okay. So the target would be 110. So if you just subtract 110 minus 100 rupees, you'll get 10 rupees here, and you subtract 100 by 5 rupees, you'll get 5, and then when you divide these two, you'll get ratio of 2:1. So this is the 2:1. In ideal case, Usually avoid 2:1 as well. At least 3:1 is something that I opt for as a trade. But in sidewise market, it's always again difficult to find these kind of trades. This is in case of positional traders. If trading is not your full time activity, or if you're just planning to have it as a medium term or long term investment, as a part of trading, then staying out of market is very important. Okay, so we need to practice to stay out of the live market as much as possible. The reason is, intraday traders will always wind up their position in the same day. So even if a particular stock is getting corrected by, let's say, 7%, it will correct by 2 or 3% in the same day. Okay, so one big advantage that it gives you is that you can spend more time on your analysis, and it will ensure that you can focus more on passive gains. Okay, with passive trading strategy, what you do is you create more cushions in your profit. Now, what is this? So let's say your initial buying was 100 rupees, the stock has, and your stop loss was 98 rupees, let's say, and it increases to, let's say, 110 rupees. Okay, now here what you can do is you can increase your stop loss to this level, let's say 103. Okay, and then stock moves again to, let's say, 120. Now your stop loss will become somewhere here, let's say 113. Okay, now what we have done is we have created a cushion of these levels. Okay, so when stock, let's say, corrects massively, it breaches 110. Here we can think maybe, okay, the price is close to 50-day moving average, and I can take a risk of additional 1 or 2%, and eventually with that cushion level, the price might shoot up. So we need to create this kind of leverage that your buying price remains always lesser than your trailed stop loss. And staying out of market, what you can do is, what you need to ensure is your trade should not return. Your trade should not require much of your efforts. Okay, so once you enter into a trade, you just need to check the closing value on the end of the day. That's it. It You should not be tracking all these stocks ticker by ticker. That is completely waste of time. It is almost like a watching television set and not doing anything. So we should always avoid sitting in front of the market. Most expert traders, which are positional traders or long-term traders or medium traders, they don't sit in live markets. They take their decisions when the markets are closed. They take the decision whether I should be exiting or buying at a certain level, or selling stock, or book a loss into a certain script. So this is something that they decide when the markets are off. So simple plans that work are, like for example, you can start with, let's say you're starting with a portfolio size of, let's say, 1 lakh rupees. This is just an example. It could vary case on case basis, but if you're starting just starting out, you can start with a portfolio of 1 lakh rupees, and your target is to take this portfolio up by 30%. Okay, so your target is to achieve 130. Now, when we buy stocks, our goal is to what? To find a multi-bagger stock. We always tend to find stocks that will double in 3 months or 3 weeks. But instead of that, if we just target smaller profits, okay, so if you see, if you're just trying to find two stocks which are going to give you 40% returns, okay, it's relatively difficult. But 40% returns on two stocks will give you 96% as total return. Okay, but again, finding these two stocks is relatively difficult. But let us see, if you take 4 trades which are going to give you 20% returns. Okay, those 4 trades, one after the other, will give you 107% as the return. So it's almost double of your original capital, and this is relatively easy. Okay, now if you make 12 trades which are going to give you 10% returns, okay, those are going to give you 214 5% returns, and which is quite fairly achievable. Okay, in bull markets, placing 12 trades is not a very difficult task. Okay, maybe in some cases, a same stock would give you 17 or 18% as a return in very short time. Okay, so it's not necessary that we should always try to stick to these values. Okay, it's okay if stock gives you 19% returns, 17% returns, or 22% returns. In this case, it's okay if stock gives 5% or 13% returns in this particular case. Okay.